We are focusing on passive activity loss carryovers. These suspended losses are a critical topic for the exam. So let's get right into how they work and where the test will try to trip you up. When a taxpayer has a loss from a passive activity, like a rental property where they are not a real estate professional and they have no other passive income to offset it against, that loss becomes suspended. It's not lost forever. It's simply put on hold. This is tracked on Form 8582, Passive Activity Loss Limitations. The key rule to remember is that these losses are carried forward indefinitely until they can be used. Let's use an exam-style example. Imagine Alex owns a single rental property. In year one, the property generates a $10,000 loss. Alex has a high W-2 income and no other passive activities. On the exam, you'd identify this $10,000 as a suspended passive loss. It cannot be used to offset his W-2 wages. It's now a $10,000 passive loss carryover. Now, let's move to year two. The same rental property generates $3,000 of passive income. The exam will test your knowledge of the ordering rules. Alex can use his carryover loss to offset this new passive income. He will use $3,000 of the $10,000 carryover, reducing his taxable passive income for year two to zero. He is now left with a $7,000 suspended loss to carry forward to year three. This is a crucial point. The losses are used against any passive income first, before any other rules apply. The most tested concept is what happens upon disposition. Let's say in year three, Alex sells the rental property in a fully taxable transaction to an unrelated party. He still has that $7,000 suspended loss carryover. The rule is that upon a complete disposition, all suspended losses from that activity are fully released. They can now be used to offset any other income, including active income like wages or portfolio income like interest and dividends. So Alex can now deduct that full $7,000 against his other income in the year of sale. Here come the exam traps. The test will present scenarios that aren't a clean sale. For instance, an installment sale. If Alex sold the property under an installment agreement, he can only release the suspended losses in proportion to the gain he recognizes each year. If he recognizes 40% of the gain in year three, he can only release 40% of the suspended losses. Another common trap involves dispositions that are not sales. If Alex gifts the property to his son, the $7,000 suspended loss is not deductible by anyone. Instead, it is added to the son's basis in the property. This is a favorite trick question. Finally, consider what happens if Alex dies. The suspended passive losses are deductible on his final income tax return, but there's a catch. The amount of the loss must be reduced by the amount of the step-up in basis the property receives. If the fair market value at death is $8,000 higher than Alex's adjusted basis, but he has a $7,000 suspended loss, the entire loss is wiped out and cannot be deducted. If the step-up was only $5,000, he could deduct the remaining $2,000 of the loss on his final Form 1040. For a mental shortcut, remember the phrase carryover, offset, dispose. First, the loss becomes a carryover. Next, you can offset it against any passive income. Finally, you fully release it when you dispose of the entire activity in a taxable transaction. Pay close attention to the word complete on the exam, as a partial disposition will not release all the losses.